Okay, well, welcome back, everyone. Let's get started with our first panel discussion, which is entitled First Principles: What Role Can and Should Financial Regulation Play in Addressing the Environment? I'm going to hand it over to Jim Poterba, who's our moderator for the session. And
I can't unmute I can't start my video without Deirdre starting that for me.
oh, sorry.
Great. Okay. Thank you. Thank you, Debbie, and welcome everyone. It is a great honor to be chairing this first session this morning and following Sarah's fabulous overview lecture on how the Bank of England thinks about the set of policy issues here, and explaining to us how the role of scenario analysis and the science fits into their policy analysis. What I thought we would try to do in this first panel is to take a step back and really attack what I will call the choice of instrument problem for economic policy and financial policy. And this being MIT, to blend in some discussion of the science associated with where we are on understanding climate change and the human role in that, and then begin to use that in some sense as a springboard to develop many of the subsequent panels that will be part of this remarkable conference, bringing together a lot of expertise on the questions which flow from Sarah Breeden's comments this morning. So we are very fortunate to have an all-star panel to address these questions this morning, spanning the science, the policy, and then the financial market aspects of thinking about climate change and what we may do about it. Our first panelist is Dan Schrag, who's the Sturgis Hooper Professor of Geology at Harvard and a Professor of Environmental Science and Engineering there. He is a geochemical oceanographer by training, so he's actually the person who really knows something about what we do when we see these measures of what's happening in climate change and how they provide the inputs to climate modeling. He's also the director of the Science and Technology and Public Policy program at the Harvard Kennedy School and directs the Harvard Center on the Environment. Dan is going to provide an overview for us on some of the science that drives the climate forecasts and is the input for the economic and integrated models that we work with. And I hope also be able to give us a little bit of a sense on how that science has been updated in the last few years, so we understand kind of what the latest developments would be. Our second panelist is Jim Stock, also from Harvard. Jim has just recently been named the Vice Provost for Climate and Sustainability for the entire Harvard University. So in some sense, channeling the remarkable resources of our neighbor university to tackle all of these interesting questions. He's also the Harold Hitchings Burbank Professor of Political Economy in the Economics Department, has an appointment at the Kennedy School, has been a member of the Council of Economic Advisors, and is, for my money, one of the people within the economics profession who is absolutely the best at channeling what is the feasible, what are the costs of taking various policy actions, and how do we think about the key benefits and trade-offs as we look forward to the next decade or even beyond. And our third panelist this morning is Bob Litterman, a former economics faculty member here at the MIT Economics Department, but also well known, I'm sure, to many of our friends in the finance community, not just as the co-developer of the Black-Litterman model for risk analysis that was developed at Goldman in the late 1980s, but also as one of the pioneers in thinking about the problems of climate risk and bringing those climate risk issues to the fore in financial markets. Since his years at Goldman Sachs, Bob has played a key role in a number of environmentally focused initiatives in the private as well as the public sector. He's a board member at Resources for the Future, the Environmental Defense Fund, and the World Wildlife Institute, and I think has been one of the real leaders in helping to think about how do you do the kind of finance-based risk analysis that we're all accustomed to, but integrating the issues from climate science and climate change to be able to think about precisely those issues and challenges. So we're hoping that Bob will actually begin to bring to us a bit of the discussion around how to think about in a financial context the risks and opportunities that the climate issues may pose. I'm hoping that we will, have opening remarks and then have plenty of opportunity for questions and discussion. But throughout this, I think one of the key questions, which I'm hoping we will attack, is thinking about the problems of climate and thinking about the role of the financial sector. How does one connect those two things, right? So for someone who came at this problem and said, I get the climate issues, but carbon tax is the answer. How do we connect that to someone who says, no, there's a really important role here to bring the financial sector in? And I'm hoping that we'll provide some discussion, which will start this off. So Dan, with that introduction, and which I hope has not put you in a place that you say, oh my goodness, he said I'm going to talk about that stuff. I'm going to pass the virtual microphone to you and let you get us started.
Thank you, Jim. And no, I don't think that puts me in an awkward situation, but I'm not going to try to review all of climate science and all of what we've learned in the last decade in 5 minutes. I think that would be a waste of our time. Let me make a few observations about how, from a science and technological perspective, this problem is evolving, and try to then ask some questions about the role of the financial world that I think is, maybe could be part of our future discussions. First of all, I think it's important to realize that concern about climate change continues to grow for a variety of reasons. I will observe that since I give lots of talks to the public and to various corporate and various other interest groups about climate change, and I have for the last 2 decades, I would say that there's been a change in the perception of climate change. 10 years ago, I think most people thought of climate change as something that was going to happen in the future, that it was something that was far off and distant. And I think people are associating climate change with extreme weather events that they either read about or actually experiencing. There are a variety of examples of this around the world. I certainly think what happened in Hurricane Harvey in Houston a few years ago, where they got almost 60 inches of rain, was extreme. The fires for the last several years, starting with the Camp Fire in Paradise, California, but then the last several years of fires across the West. Last fall, front page of the LA Times declaring the climate apocalypse is here. It was a little extreme in my view, but certainly that reflects a public perception that climate change is not just about sea level rise 100 years from now, but it's actually about experiencing impacts now and vulnerability now. I think that's really interesting. We saw the remnants of Hurricane Ida that hit Louisiana, but then killed 50 people in New York and New Jersey. Suddenly we were talking about basement apartments. We never talked about basement apartments as a vulnerability point before. And by the way, the 3.5 inches of rain that Central Park in New York got in 1 hour pales in comparison to what happened in Zhengzhou in China in July, where they received 8 inches of rain in 1 hour, 8 inches. People drowned in subway cars as the subway literally filled up with water. Absolutely terrifying as someone who took the subway to high school every day in New York growing up. So I think all of those examples illustrate the kind of vulnerability that people are feeling around the world. And that is an interesting dimension of this problem, because people, I think, are talking more about vulnerability and adaptation. For the environmental community, even 10 years ago, adaptation was not something in the US that you wanted to talk about because it was an excuse for not doing anything about reducing emissions. That was the George W. Bush approach. We're just going to adapt to it. Adaptation is not a joke anymore. It's serious, it's expensive, and it's significant. And I think there's a big role for financial mechanisms here. The bankruptcy of PG&E in response to the $13.5 billion settlement after the Camp Fire is a nice example. That essentially puts the financial responsibility for the Camp Fire in Paradise, California, on the backs of ratepayers all across Northern California. I would argue that shields the people in paradise from the responsibility. In my view, I'm, it's tragic what happened. Over 85 people died, and many, many more people lost their homes. But those people shouldn't have been living there. That was a dry forest that occasionally burns. And frankly, we need to, whether it's forests in California or whether it's people living on the coast in Massachusetts or the Carolinas, we need to put financial incentives in place to move people out of harm's way. Now, we've taken some steps towards that. We're trying to reform federal flood insurance, but the fact that we have federal flood insurance is kind of a ridiculous thing, because private insurance companies won't sell insurance to people on the coast. It's a mistake. Same with crop insurance for farmers. So we have a lot of perverse incentives to encourage people to live in harm's way or do risky things. And I think we have to think hard in the coming years about financial regulation and reform in terms of insurance and other policies. I think what's the other important thing that is driving a lot of action on climate is frankly good news about technology, which is that solar and wind and learning curves and batteries have gotten incredibly cheap. So, despite having a president of the United States for the, previous 4 years who had some passionate hatred of wind and solar, solar and wind represented about 3/4 of new electricity generation addition in the U.S. That's extraordinary. 3/4. That just tells you how important markets are relative to politics in the energy sector. I think that's a very interesting trend, and we see that all over the world. Ford and many other automobile manufacturers are making huge investments in EV factories because batteries are cheap and EVs look like they really are the future. So that makes climate policy easier when you see technologically sophisticated and affordable solutions that look feasible. So we have to give learning curves and the cost drawdowns in technology a big role in this. I will end though on one small point, which is that there's a growing, what I call the renewables gap in the world. There are many countries, including China and India, that have embraced renewables because of economics, and we're seeing those countries soar past 10%. Ireland is at almost 40% wind. The US is about 12 or 13% wind and solar electricity. And so all the countries of the world are getting there. But the fact is there are many, many poor countries in the world, or rapidly developing countries, Indonesia, Pakistan, Thailand, many, many others, that essentially have zero wind and solar. This represents a grand market failure. And I think the discussions in Glasgow, out of Paris, honestly have become a little bit too nationalized. There's been a little too much focus in the US and in Europe about how are we going to decarbonize the US? How are we going to decarbonize the UK? How are we going to decarbonize Germany? Everybody's focused on their own decarbonization pathway and getting to zero. And that's wonderful. But I think what we're not seeing is that this is a global problem. It doesn't really matter what US emissions are. It matters what global emissions are. And I would say there's a very important role for financial markets to make sure that these countries that are essentially haven't even gotten out of the gate yet, where renewable technologies are not competing, not because they're not cheaper, it's because of a variety of other factors. In some cases, it's corruption. In some cases, it's experience. But I think clean energy financing in poorer countries of the world has to become a major focus. Leading is not just charging off ahead. Leading is bringing everybody with us. And this is a global collective action problem. And that requires a combination of financial investments, but good policy that I think is very tricky and frankly, politically a challenge right now in an era where, to me, it seems both the right and the left in the US are a little bit America first and not thinking so much about the rest of the world. I'll leave it there and let Jim and Bob comment.
Great. And thank you for a great start. Jim, can we pass the virtual mic to you?
Okay, so thanks very much. And again, delighted to be here. Thanks for asking me. I'm looking forward to the general discussion. I have a few slides to share. So I'm assuming, are we, there we go. Yes, okay, good. All right, so let me just get this started. And I'm going to try to pivot a little bit into the finance space, and then of course Bob can follow up on that. So thanks so much, Dan. And actually, Dan made a really great point about the international aspect of this, a global aspect. Obviously, this is a global problem, and we need to address it globally. I happen to think that some focus on the U.S. is especially warranted. There's no way that we can exhibit leadership in this area unless we actually do decarbonization ourselves. And moreover, it's really on the developed economies, like and especially the U.S., to develop the new technologies that are needed and make those cheap, so that the rest of the world can afford to follow. Let me just make a few comments. So I have 4 facts that I want to just summarize here, high-level facts that frame the economics of the situation and the policy situation, and then I want to turn to the finance side of things. Okay, so just to get some numbers out there, there's currently a review by the US government of coming up with an improved estimate of the social cost of carbon. The social cost of carbon is the net present value of climate damages for a ton of emissions today. Current working value is about $50 a ton. That actually dates back, the methodology on that is quite old, and there's been a great deal of good work, Berkeley and at Chicago, and Resources for the Future, and a number of other places too, that have been updating this. A current set of estimates, I expect what the U.S. government estimate's going to do is it's going to be somewhere in the $50 to $175 a ton range. Of course, that's a big range, but there's a lot of uncertainty. So I think it's reasonable to have a pretty big range. I'm just putting up one of the most recent estimates that's available in a forthcoming Brookings paper, and it sort of shows what different discount rates can accomplish. So that's just a useful number. So how much is, what are the damages in monetary terms? Useful thing to keep in the back of your mind as we're thinking about policies. Second point, it's another important thing to remember. There's a lot of green good news out there, the declining costs in solar, the declining costs in wind, batteries. It almost feels like, depending upon which podcast you listen to, it almost feels like, gosh, this transition is inevitable. We're going to see this happen. Well, I think I think that we need to be careful about feeling too good about where we are. So far, we have reduced emissions since 2005, almost entirely by switching away, well, for 3 reasons. We had the financial crisis, we had the COVID crisis, and then in the intermediate period, we had a transition from coal to natural gas because of fracking, and natural gas prices were cheap. So far, we've had limited effects on policy, and limited effects as a result of policy. Some state policies have been important, but by and large, not so much. Mainly, we've just been riding this wave of cheaper technology. So we have ambitious goals. So the Biden administration wants to hit 50% reduction by 2030 as the new Paris target that they want to bring to the COP meetings that's coming up. How in the world that's going to be done credibly is an open question. Green technology costs, as Dan mentioned, this is terrific. Green technology costs, it is cheaper to use solar and wind now in much of the country than it is to even run a coal plant. So I think we're going to be seeing increasing coal retirements, depending upon where it is. What I plotted here, though, is quite a credible model, in my view, very recent calculations based on current data of what it might look, what business as usual, that is no new policies would look like, but, declining renewables prices and so forth. And this is emissions from the power sector. And essentially what one sees over the next 15 years is a very modest decline in emissions from the power sector. Our goals, the administration's goals, are to have 80% emissions by 2030. That's this gray line right here. We're nowhere close. So business as usual, despite cheap batteries, despite cheap wind and solar, it could in an optimistic scenario sort of have some substantial improvements, but we are a long ways away from where we need to be. My view is that has to come through major policies. What are those policies? Well, here's an example of something that's being kicked around now in Congress, like literally now, which is combining a very low carbon tax, $20, and an extension of some renewables tax credits and for the power sector. You can see that a very, very modest policy actually changes the economics quite substantially. It makes coal quite expensive to use, and it increases the price of natural gas, and it makes it much more beneficial to shift over to renewables with battery storage, battery backup, and other types of backup. So this is just an example. The policies really matter. It doesn't have to be a carbon tax. I put that in because this is actually something that's live under discussion right now. There's kind of an interesting report, quite an interesting report that was just released yesterday by the Rhodium Group that goes through some modeling of what it would take to get to 2030, I misspoke, to get a 50% emissions reductions by 2030, which is the proposed Paris targets for this administration. It is sobering to read the list of things that need to be done. Some of them are being done in reconciliation, but basically there's some really big steps that need to be taken. Most importantly, something to decarbonize the power sector. So there's a whole host of policies. One thing I would say for people for sort of the generic, sort of general purpose economists, it's easy to say carbon tax and then we're done. But I think there's a couple of reasons why I would push back on that. But most importantly, from a sort of an economic theory perspective, is that we have a lot of different market failures here, and with different market failures, there can be different types of policies that are more fine-tuned to the specific markets, and they can be quite effective and not costly. Okay, so where does finance fit in? We have a long ways to go. Let's imagine that we're in a scenario where Congress, for public policy, isn't going to do what we need to do. We need to decarbonize. And so is there a role for finance and financial research? I'm going to propose three buckets for types of research in finance. And I mean this to be a little bit provocative, and it's okay if somebody wants to push back on this. I think the first bucket is, let's see if we can profit from the energy transition. And there's a lot of opportunities. There's a lot of stuff that's going to be happening, shorting coal over the last 8 years. I suspect we might hear Bob tell us that would have been a really good strategy. So there's the alpha side of this. There's probably also the beta side of this too. If you want to hedge against climate risk, that's perfectly fine. There's also the aspect that a lot of people want to feel good about their investments. And if you can provide them a product that helps them feel good, that's a traditional market for traditional activity of not just financial markets, but of all markets. I don't think of any of this list as being something that actually particularly moves forward decarbonization or even helps with systemic ability, but it's stuff that one could do. In terms of just how business is done in financial products. There's the aspects of categorizing and understanding systemic risk, and Sarah Breeden just gave a terrific summary of thinking about that and how that's approached at the Bank of England. So I don't need to say any more. Potentially, quite an important undertaking. The one that I'd like to focus on is what is really there in the finance sector that can help drive the energy transition. If we have, as I think we probably do, as we certainly have had, and reasonable to project that we will have, a dearth of concerted and efficient and effective federal leadership in this area, is there a role for a Plan B financial sector? And I think this is an open question. And I think it's kind of I would put the burden, and here's the challenge, I would put it on the financial analyst community, the academics and the analysts, to really show that these actions can make a difference, that financial market interventions or financial activities, I listed some here, green bonds, green banks, divestments, disclosure, direct investor activism, is this what is this all about? Does this actually have impact? Is it virtue signaling? Is it greenwashing? I'd like to know. I think this is, I'm not a financial markets or financial analyst or financial researcher. I'd love to hear what the views are. But again, what I'd stress is the question is the financial market able to be a plan B in the absence of the first best or the first best federal policies that would drive forward the energy transition. And I'd like to hear some, really thoughtful analysis that tackles this head on. So thanks very much. Look forward to hearing Bob.
Okay, Jim, thanks so much. And also for setting out a framework, which I think can keep us in good stead when we get back to the question period. So Bob, we'll pass the microphone to you.
Well, thanks, Jim, and thanks for inviting me to this, very interesting conference and panel. I come at this as, a risk management professional from the financial industry, and climate change to me is fundamentally a risk management failure. Financial risk management has several simple principles that apply also to managing climate risk. So let me start with those. Most importantly, risk management requires imagining worst case scenarios. A risk manager's job is not just to maximize returns, but to prevent extremely bad but plausible scenarios. Identifying those scenarios is especially hard for climate risk because we're performing this experiment for the first time. It's irreversible, and the impacts will be felt for decades to come. In this context, it's extremely important that risk managers explore worst case scenarios, not just the expected scenarios. Another principle of financial risk management, which is perhaps not as obvious, is that our objective is not to minimize risk, but to price risk appropriately. Not incentivizing reductions in carbon emissions is the fundamental source of the climate crisis. Pricing carbon is the first imperative. Now, a third principle of risk management is that time is a scarce resource. If we have enough time, we can solve almost any problem. It's when time runs out that a risk breeds catastrophe. The risk from climate change is increasing as we fill the atmosphere with greenhouse gases. We do not know how much time we have before we cross a tipping point, after which a nonlinear increase in the extent of such disasters becomes irreversible. This is an extremely urgent matter. More colloquially, we're barreling toward a hazard of our own making, and now we need to brake fast and hard. Last year, I had the honor of serving as the chair of the Commodity Futures Trading Commission's Climate-Related Market Risk Advisory Subcommittee. The CFTC is responsible for regulating the derivatives markets in the United States to ensure integrity, resilience, and vibrancy. Members of the subcommittee included representatives of market participants, banks, institutional investors, non-financial corporations, and a commodity exchange, as well as academics and nonprofit organizations. We focused on the principles of risk management outlined above, and that led to a clarity of vision that allowed us to create, and most significantly, unanimously support a detailed roadmap for managing climate risk in the U.S. financial system. The roadmap focuses on two types of climate-related financial market risks, specific risks, for example, to individuals and corporations, both transition risk as we transform the economy to net zero emissions, but also from physical risks such as sea level rise, increasing droughts, extreme weather events such as storms, floods, and wildfires. They're expected to increase in number and intensity over the next 50 years. Specific risks are growing over time, but they are manageable. The second type of risk, which I'll come back to, is systemic risk to society. Specific risks take many forms. For example, in the Western US, scientists have established a link between the area burned by wildfires and climate change, which creates dry and warm conditions amenable to large wildfires. This has clear implications. We've recently seen the Southwest experiencing record wildfire seasons, exacerbated by both land management practices and climate change. The confluence of these factors has real costs. Another example is flooding incidents in coastal regions brought about by sea level rise. This is a visible and accelerating manifestation of global warming. Higher sea levels increase the risk of damaging floods in coastal areas, whether they are driven by tides, storm surges, or other weather events. Markets are already starting to respond to this increasing risk with detectable changes in prices due to perceived flooding risk. This pertains significant financial risks as we reported in the CFTC report. Declining real estate values driven by climate-related impacts or the perception of such impacts in the future could substantially depress economic activity. Some populations and local communities within the United States may ultimately be required to relocate with potentially significant economic losses for households and investors. That's not to mention what happens outside the US. It's going to be much worse in many low-lying cities in Asia. Lastly, scientists in recent years have begun to identify how climate change has affected individual weather events. As the symptoms of climate change develop, they will continue to increase risks to infrastructure and economic activity. The distinguishing feature of specific risks is that they can be insured against. And of course, they should be. Investors can diversify exposure to specific risks, and they can share them broadly through insurance markets and reinsurance. The costs of insuring against climate-related risks will no doubt rise, but in a market economy, those increased insurance costs send powerful economic signals that individuals and corporations will be safer if they avoid exposed locations and prepare for extreme weather. Unfortunately, these actions are not enough. There are risks that are so extreme that there's no way to diversify the exposure. They are systemic. This is the second kind of risk we need to manage, and it requires a societal response. No entity, for example, can insure society against an equity market crash, nuclear war, a global pandemic, and similarly, none can insure society against the systemic exposure created by climate change. This risk requires a systematic, coordinated, and comprehensive national and global policy response. Today, when specific risk protections are inadequate because of the scale of the disaster, we depend on the federal government to provide an emergency backstop. But we cannot simply assume that such a backstop will always be there. We need to act decisively today to ensure that more and more federal bailouts will not overwhelm federal coffers in the case where climate change is unmanageable. If we were to find ourselves in that world, domestic disaster response would not be the only challenge. The indirect effects of climate change, new pandemics, threats to national security from failed states, or climate-induced mass emigration, economic retraction in some places will also demand a response. In a world where the effects of climate change are severe, society is likely to have to start removing CO2 from the atmosphere by artificial means to restore lower temperatures, and that's going to come at great expense. In that scenario, which is likely to occur, every ton we release today is a future liability. To avoid the worst of these systemic threats, we must transform our economy to stop emissions. The scale and urgency of that transformation require that financial markets immediately and dramatically increase the flow of capital toward investments that will reduce emissions. Then we will almost surely need to follow that by removing significant quantities of greenhouse gases from the atmosphere. Making those investments profitable and fostering the innovation necessary requires putting a price on carbon. As the CFTC Subcommittee on Managing Climate Risk in the Financial System put it, quote, "This report begins with a fundamental finding. Financial markets will only be able to channel resources efficiently to activities that reduce greenhouse gas emissions if an economy-wide price on carbon is in place at a level that reflects the true social cost of those emissions." Now, let me note some of the other observations of the subcommittee. The lack of common definitions and standards for climate-related data and financial products is hindering the ability of market participants and regulators to monitor and manage climate risk. Climate-related scenario analysis can be a useful tool to enable regulators and market participants to understand and manage climate-related risks. As Sarah Breeden noted in her opening remarks, these scenarios need to include both top-down and bottom-up analysis, but they are at an early stage of development. Insufficient data and analytical tools to measure and manage climate-related financial risks also remain a critical constraint. Disclosure by corporations of information on material climate-related financial risks is an essential building block to ensure that climate risks are measured and managed effectively. The existing disclosure regime has not resulted in disclosures of a scope, breadth, and quality to be sufficiently useful to market participants and regulators. Cooperation with international efforts to coordinate financial regulation need to be much more robust. Since the CFTC report was published, a new administration has been elected to the White House. We have a new Treasury Secretary leading the Financial Stability Oversight Council, and the leading financial regulators, the Federal Reserve System, the Securities and Exchange Commission, and the Commodity Futures Trading Commission are all taking appropriate steps to address climate risk. And so I'm very pleased with that. And that finishes my remarks. Jim, over to you.
All right, thank you all. This is a fantastic start. So I'm going to kind of tee up a couple of questions, and then I know we're getting some questions in the Q&A that I'm going to return to. And I'm going to start by taking a comment that you made, Bob, and then I'm going to bring it to Dan and to Jim. Because both Dan and Jim talked about the technological progress that we are making and have made in the last decade, which has significantly lowered the cost of moving to a low carbon transportation system, and also of moving to a low carbon electricity grid. And those, I think we all sense are really important. You mentioned, Bob, that we are inevitably going to have to go to carbon capture at some point along the way. So a question for Jim and Dan is, what do you see in the crystal ball of, how, at what point are we might we get to a point where for new energy sources, we are choosing the low carbon versus the high carbon alternatives, right? Where we've really turned the corner on that. And then how do each of you see this role of carbon capture? And is there any favorable news to report on thinking about the technologies there? So Dan, maybe you want to start, and then we'll move to Jim.
Sure. I think Bob was referring to direct air capture or removal of CO2 from the air, which is very different from carbon capture. Generally, when we talk about carbon capture and storage, we're talking about taking CO2 out of a flue gas from a coal or gas plant or a industrial site, perhaps a fertilizer plant or a chemicals plant, and then injecting that CO2 underground. That allows you to use the fossil fuel, but not let the CO2 get into the atmosphere. And think of that as a competing technology for a variety of other forms of non-carbon emitting energy systems. I think it's very important to understand that we're in the early stages of this process. There's some countries in Europe that are further along because they've already reached 20, 25, 30, 35% wind and solar penetration. The reason that's important is that at low wind and solar penetration, managing the intermittency of wind and solar isn't that difficult. We're still in the easy part. In Ireland, where they're pushing 40% wind, they have a real problem. And what they do when the wind doesn't blow, and sometimes it doesn't blow for 2 weeks at a time, they turn on their gas and coal plants and emissions go up. So we have dispatchable fossil energy. As we push towards lower emissions overall, getting rid of that dispatchable fossil energy is really challenging. And so that's a decarbonization problem. And we haven't figured that out yet. There are many, many different proposed solutions, but it's not at all clear what's going to win yet. Carbon capture and storage is one of them, but I would say there are a variety of other ideas for how to get around that. And we'll let the market work that out. What Bob was talking about was something else, though, which is direct air capture. And it's something I'm working on technologically. I actually just filed a patent for an idea for that. The problem is even the best ideas in this space are going to be expensive. There's some just fundamental energetics of the problem that are hard to work around. So there's not going to be a cheap, free, easy way to remove CO2 from the atmosphere. But here's the fundamental challenge, and I know Bob agrees with this. This is a global collective action problem, and figuring out imagining a world where people are willing to pay significant costs to remove CO2 from the atmosphere. Could you imagine doing that when there are still countries using coal and putting it in the atmosphere? That's difficult to imagine. And when we're talking about numbers, we're talking about numbers between $100 and $300 a ton of CO2. So we're talking about significant amounts of money spent to remove CO2. in a global collective action, it's everybody's atmosphere. So to me, the hard part of that is not the technology, not, eventually we'll try to figure out how to get the costs as low as possible. It's figuring out the world order that exists, the global governance that allows you to do this in an effective way. And I suspect Bob would agree with that.
Yeah.
So Dan, that's actually in some ways, that's an optimistic observation, because it means before we get to the direct air removal, there's a lot of lower cost ways by just kind of moving substitution from coal burning to other things along.
I just want to be very clear.
Yeah.
There's a lot of optimistic and wonderful rhetoric from environmental groups, from the political left, and from Europe about timescales of decarbonization. I've been modeling low carbon energy systems for a long time. We never know. It's certainly technically possible to achieve very low carbon emissions in a relatively short amount of time, but it looks politically ridiculous.
Yeah.
I don't see how we actually get there. Just as an example, recent study out of Princeton estimated that a low non-carbon net zero electricity system in the US would require something like 3 to 5 times the current length of transmission, just as an example. Currently, we're building about 2/3 of the existing transmission per year. So you're talking about rates of acceleration. And by the way, permitting any kind of transmission in the US is very difficult because we have 50 years of environmental law that's all designed about stopping development. And climate change is the biggest development project the world's ever faced.
Mm-hmm.
So this is creating a schism in the environmental movement, because the traditional environmental approach is to stop all the building. And yet climate change is about building as much as quickly as possible. So I don't think we're going to figure this out. My own view is it's going to take a lot longer than the rhetoric we're going to hear in Glasgow, than the aspirations of political leaders. And what that means is the real impacts of climate change are going to grow. The other thing that Bob knows, and Jim knows, but people forget, is the Earth system has incredibly long timescales. We are unleashing forces that have timescales not just of centuries, but of tens of thousands of years, that are essentially almost unstoppable at this point. So the climate impacts are not going to go away when we bring emissions to zero. If you can imagine that world, and I suspect it's going to be our grandchildren who have to deal with this problem, but if you could imagine a place where we do finally get close to zero emissions, and I don't think I will see it, and I don't think my children will see it. I wish that were not true, but that's what I believe. But in that world, how will the world figure out how to start to actually lower CO2 emissions and bring the climate risks back down? I think it's a fascinating question, and many of us are thinking about that, but it's hypothetical now because we still have low-hanging fruit. We're not even at 15% wind and solar in the US. And so spending a lot of time worrying about CO2 removal seems a little premature.
Yeah, no, and Dan, I should say it's always great to bring a geologist to talk to a group of economists and finance people, right? And when you talk about timescales, it reminds the finance people there is something besides the end of today's trade, and it reminds the economists there's something beyond the 10-year budget window that we have to think about. So this is really helpful. Jim, let me come to you and also add a tweak to the earlier question, because maybe you could talk on this choice of instrument question, right? You laid out a wonderful litany of how to think about the role the financial sector can play. We also talked earlier in your remarks about carbon taxes and estimates of social cost of carbon. Can you say anything about the interaction between the financial policies you mentioned and the cost of carbon, something like a carbon tax or an equivalent policy? Do you see there being a positive interplay between those two? Can the financial sector enable and facilitate the impact of the carbon tax in some way if we had one?
That's a great question. So let me just actually address the first question first, which is just a word on the carbon removal. And I think carbon removal is a good word because it sets the stage for a lot of different technologies that would remove carbon. I think it's really important to underscore what Dan said, which is that this stuff is certainly expensive. We don't know quite how expensive because the technology hasn't really gotten to the point where we would know, but it's pretty one way to think about it is nobody's talking about nitrogen removal. That is not on the table, because who would spend money to remove nitrogen from the atmosphere? Just a pointless thing to do. The only reason we would remove carbon from the atmosphere is if we're willing to pay for it. So, it's quite sobering. Some of these simulation studies, and there's a special report, the 1.5 degree report put together by the IPCC. They were looking at overshoots in concentrations such that there would be 20% of emissions today, 20% to 40% of that would be being removed in mid-century. So we're talking about a carbon removal system that's maybe 1/3 the size of the current fossil fuel system. I mean, this is just a mind-bogglingly huge numbers. I think there is one role, so I'm quite pessimistic about our actually deploying it at a large scale for removing carbon from the atmosphere. I do think that it potentially plays a really significant role as providing a really firm offset. There's a lot of debate over whether offsets are real and, but actually taking it out of the atmosphere and sticking it underground or transforming it into rocks or something like that, that's like a real offset. And certainly one pathway one can imagine for aviation might be that the cheapest thing to do is to use some carbon removal technology combined with petroleum jet fuel. So, I mean, there's areas that it could have niche roles. Going back to the carbon tax and financial interactions, one of the biggest virtues of a carbon tax, and I'm specifically saying carbon tax, not cap and trade or other pricing mechanisms, is that it puts an explicit price on carbon across the entire economy. And that is the sort of thing that firms can then count on, and they can make plans against, and they can use in making their investment, their long-term investment, and their long-term research decisions. If you couple that with a robust research program funded generously by the federal government that would look at lots of different potential technologies, those are the sorts of things that really worked in pharmaceuticals. They're the sort of things that have worked in lots of areas of our economy, and they could work here too by sending this really firm price signal. The flip side, you asked, like, how is it the financial sector could make a carbon tax more effective? I think it would just do that automatically. It would do that automatically by firms responding to what are clear and distinct incentives. Right now, we've just got a mess, and there are a lot of firms out there taking flyers, and so great for the green VC community, but there's a lot of finger crossing in that community too. So I'm crossing my fingers for them, but I'd prefer not to have to.
Great. So Bob, I want to come to you now and channel one question that's come in from the Q&A and something else that was raised by Dan. And this is the role of insurance, and how do we think about risk markets in providing insurance and all this. One of the questions that's come from our audience is just, how do you think about the stranded asset portfolio as a way of proxying climate risk beyond fossil fuels? Is it just a fossil fuel tool, or and how would you integrate, as it were, lessons from thinking about stranded asset portfolios to try to enlighten the scenario analysis that's being discussed by central banks and others? So maybe you could just kind of expand a little bit on that risk issue. The other thing I just wanted to raise, and I want to come back to Dan on this one after you, is Dan talked about the role of insurance markets in some way encouraging people to build in climate prone areas, or to continue to expand land use in high fire risk places and things like that. It's not just sea level, right? It's also the fire risks. And one reaction to that is, well, this is just, and maybe I'll call this the economist reaction, is, well, if the insurance was priced fairly, it's just getting people to bear the cost of what they're doing. And if my fire insurance for building in the California, wildfire prone areas is 20% of the price of my house, but I want to live there, that's the way it is. I think there's another, view, and I don't want to associate this with Dan, but I think Dan's comments would lead some to think of this, is we just shouldn't provide that insurance. We should shut down those markets so the building can't take place and people just know they're going to lose everything. And I wonder if you want to just jump in on this issue of the right role of risk bearing, and how do we think about this? But start with the stranded asset portfolio, because I know that's immediately in your wheelhouse. Then we'll come back to the other.
Sure. Thanks, Jim. Well, stranded assets, it's an interesting, very interesting thing that's going on. And let me start by saying I heard about stranded assets about 10 years ago from, it was a white paper from Generation Asset Management. So it's not something I came up with, but I did think, that makes a lot of sense. There are some obvious assets whose valuations do not reflect climate risk. And in particular, coal, tar sands, other expensive sources of oil and fossil fuels, and shorting that, as you note, has been a wonderful financial winner. We entered into what we call the stranded asset swap at the World Wildlife Fund about 8 years ago, and kept re-upping it every quarter. And those stranded assets underperformed the market by an average of 18% per year. And you can imagine when that goes on year after year after year, that is a huge revaluation. So basically what we've seen is that fossil fuel assets have been revalued. Now you have to be careful because that wave went through the economy. And in the last year, stranded assets have bounced back. I like to point to Peabody Coal, which at a minimum was worth about $80 million. Now it's worth about $2 billion. So you didn't want to short Peabody Coal a year ago. It was already stranded, and now it's come back. So what we're seeing is waves rolling through the economy. 7 years ago, it was obvious that fossil fuels, well, it was obvious to some of us. Obviously, the prices were where they were because it wasn't obvious to everyone. But it seemed obvious that they were going to decline in value. And similarly, it seemed obvious that, certain technologies would be winners, like Tesla. I bought a Tesla 5 years ago, and I thought, this is an amazing car. I should buy the stock. And then I looked at the valuation, and I thought, this is insane. Well, it's gone up 4 times since then. So, that was obvious. Now we're seeing these impacts move through the rest of the economy. Things like steel, cement, carbon allowances are being impacted. And what that means is something very interesting, which is that while the stranded assets are now rebounding because of what's going on in the energy markets, you've also got carbon allowances that are shooting up. So, it's not, everything in the economy is not moving together with this. And then you've got, I would say, things like coastal real estate, where I don't think those impacts have been priced in at all. It's still quite expensive to buy on barrier islands in New Jersey. And, I think they've got maybe 20 or 30 years. But if you try and get a mortgage on those properties 20 years from now, I think you're going to be in big trouble. So, the point is that these things are not all happening contemporaneously. Now, the Fed has looked at the stranded asset returns as a climate-related factor, and I certainly agree with that. But you do see that, where you are in this transition impacts how things are being revalued. And so I would say today, if I were the Fed, I'd be much more worried about the overvaluation of some of these assets than about the underappreciation of the stranding potential for other assets. I don't think that the collapse of the coal industry at this point, which is worth, a few $1 billion, is a significant financial risk. Tesla, which goes up and down 20 or $30 billion a day, if that were to collapse, that might be a problem. So that's my point on stranded assets. It's perhaps a little bit more complicated than you would have hoped. And then on insurance, I think all economists would probably agree. You have to give people the right incentives. So when the government comes in and subsidizes flood insurance, it creates a problem. And if the government in California were to come in and subsidize homeowners insurance in forests, that's going to be a problem as well. It's being discussed. Let's hope they don't do that. What's going on right now is it's almost impossible to get fire insurance if you're in a fire-prone area in California. And it should be much more expensive, as you suggested, Jim. And then people will make the right decisions. They'll move to hardened areas in the cities. That's what humans are going to have to do in the face of climate change over the next, 50 years. We're going to have to adapt and harden ourselves. The sad thing, and it's really sad, is that nature can't harden itself. nature is going to have to suffer the consequences that humans have created. And we don't know how bad that's going to be, but it could be really bad, especially outside of these hardened cities. So I would say, it's imperative that we immediately create the incentives to reduce emissions. It's insane that we don't have those in the United States today. And as Jim mentioned, that's being discussed right now as part of this reconciliation bill. And it's very possible that Democrats will create a carbon tax. The low tax that Jim, I think, mentioned actually increases very quickly. It gets up to $50 a ton by 2030 and $100 a ton by 2035. And it's those expectations of future incentives to reduce emissions that are critical today. You have seen an absolute change in the financial community. Now there is tremendous investment in the low carbon economy. I mean, you're seeing it in the valuation of Tesla and battery companies and all these things. Clean tech is just going crazy because investors are forward looking. And so they expect to see those strong incentives, and they're investing now on that basis.
So let me, that was fantastic, Bob, and thank you. So let me, we're running close to the end of our time. I want to link back to Sarah's initial comments, and there was something that Sarah showed us a slide on the scenarios that the central banks, in some sense, are thinking of responding to. And I think that scenario kind of had a global carbon price that was something like $175 a ton in 2030 as kind of one of its kind of benchmark numbers. And as I understood what she was showing, it was, in some sense, if we're going to be on a trajectory of carbon emissions that would get us to where we want to be in 2050, we need carbon pricing that is kind of at that level within the next decade to be able to do this. So I want to just kind of come back to all three of it. I'm going to start with Jim and then go to Dan and come back to you, Bob, last. In some sense, if we think about what central banks or other financial institutions are doing, one view is we're going to get on a scenario like what I've just described. We're going to do something to get to 2050 big reductions, and therefore we ought to be recognizing that that's going to create a lot of economic shockwaves, and those are the systemic forces that need to be adapted to in setting policy. And we just got to recognize that, right? Another view is it's just incredibly optimistic that we're going to find the political will to be able to do any of these sorts of things. And if we are not, and the financial system is taking actions to prepare for that situation that's not going to materialize, this was in some sense an inappropriate action to take today, given where we're going to be in the economy. Maybe the future is going to be even more damaging, but it's further out. It's on Dan's time scale, not an economist's time scale in terms of what we're doing. Jim, can you help to kind of put these pieces together in terms of thinking about, what happens if we're not seeing the other actions that change the economy, and what are the implications for the financial sector? And then Dan and Bob, if you want to comment on that as well, that'd be great.
Great. So let me just make a couple of comments on that. So so I think, once you get a bunch of economists in the room, the first thing they say is a carbon tax, and we all agree that a carbon tax is really important. And as I said, a price on carbon, actually, what I really mean is I mean a carbon tax. So something that has a planned horizon that you can actually really bank on for exactly the reasons that Bob mentioned. That said, it's really important to remember that policy by itself isn't enough. It is not sufficient. So I think it might be necessary, probably is necessary, but it certainly isn't sufficient. There's lots of other externalities. An easy example is thinking about electric vehicle penetration. You could have a carbon tax of, let's call it $100 a ton. Next week, that's going to make gasoline $1 a gallon more expensive. If you do the calculations, that's actually not going to have much of an effect on your decision to buy an EV. You're going to buy an EV because of the price of the EV, or maybe other incentives. And even if you decide, well, gosh, because that carbon tax, I might want to buy an EV. unless you happen to live, and I'm sure Bob does, and I do, I charge my EV in my garage. But what about the people who don't have it in the garage? What about people who want to travel to go long distance? You need to have the charging stations. There's a chicken and egg externality there. There's a really important role that for very cost-effective federal policy, government policy, to incentivize charging stations, to provide charging stations, and to cost share on those. So there's a lot of other externalities that need to be addressed. A carbon tax is important. It's not sufficient. Second comment is that politically, and certainly here in the United States, but actually this is true in a lot of countries, except for maybe in Scandinavia, having high levels of carbon taxes are just really a big push. But we are willing to look at policies that have $125 shadow prices in other areas. So we can think about cafe standards, we can think about biofuels policies, we can think about a variety of different policies that currently have, or rooftop solar, that have shadow prices in that vicinity or have had them in that vicinity. And I believe that her number, if I heard her presentation correctly, it's not as though there is a $125 carbon tax. There are policies in place that have a shadow price of $125 a ton. And I think that's a reasonable way to think about it, that we might be willing to do that. And then the question is, what is that combination of policies that will be efficient and effective, that a carbon tax at a lower level could be part of that, but then there are going to need to be other things. So an example might be an EV, a zero emission vehicle standard or something like that, that's going to require some transitions. And you could easily have that within this concept of $125, but it wouldn't be a carbon tax. So maybe I'll just leave it at that. And I'm probably not going to take up that final point about financial markets. I think I'll go back to my basic challenge for the researchers in the rest of this conference, which is, what if you put on it is okay to look at this from different hats, like the hat I want alpha, the hat I want beta, the hat I want systemic risk minimization. But why don't you try putting on the hat, we aren't going to actually get good federal policy, certainly not first best federal policy. Is there something constructive that financial markets can do to actually drive this energy transition forward? And if so, what is it? And given that everybody here is an analyst, can you show that?
Okay, thank you. Dan?
So I think I agree with everything that Jim's just said, but also what Bob said, I think is really important on terms of managing the risk and thinking about the stranded assets and energy systems, et cetera. I will say though that deregulating insurance, having pricing risk appropriately, both in the energy sector and in every other aspect of our lives where there's risk, housing and whatever. This is a little bit like relying entirely, as Jim says, on a carbon tax, where it's probably the right thing to do to provide the right incentives for people to do the right thing. The problem that climate change poses, though, is that we have all over the US people who have lived in certain places for sometimes decades, sometimes centuries, old communities, cultures. Think of certain communities in New Orleans or certain communities in other parts of the US, where they are now facing new risks and new vulnerabilities. And we have tough decisions about saying, okay, essentially, if we just let straight economics rule and we let them bear that risk, those communities will disappear. That may be the right decision, but socially, politically, we have a lot of trouble with that. How do we think about poor people down in Scituate in Massachusetts, whose entire net worth is the value of their home on the beach, and those homes are going to get destroyed? We have a federal safety net. Outside of climate change, this happens all the time. People in the Bay Area in California don't buy earthquake insurance because it's too expensive. They assume the federal government will bail them out if they get in trouble. And the time will come when the federal government won't be able to do that. But we have a lot of tough political, social choices to make. And that is something to understand. The final thing I'll say is that there's a little bit of hope I see. I do think investors are hesitant on making long-term investments in fossil fuels, given the policy uncertainty going forward. But as the non-fossil energy sector grows, remember that in the US, willingness to pay is not just the shock that people feel and then vote against policies. There's a lot of post-Citizens United, a lot of corporate money in politics. And as the winners of climate action, of carbon tax or equivalent, start to become as significant as the losers, I think we'll start to see a political shift. Right now, Senator Whitehouse from Rhode Island said, climate change isn't a partisan problem. It's a campaign finance problem masquerading as a partisan problem. And I think that's very insightful. You have Amazon and Google and Walmart saying they're green, but if you ask how much are they spending on lobbying on climate change, how much are they giving to candidates on climate change, the answer is almost nothing. Whereas the fossil fuel industry is still heavily funding campaigns of people who oppose climate action. I think I'm optimistic that that's going to start to change as the Teslas of the world, as Ford, as other big companies start to see that climate policy is good for their bottom line. They're going to put political money in the game, and that's going to accelerate the change. I would say that's a political hopeful perspective, but it may be a good one to end my comments on.
Yeah, no, that's really interesting. All right, Bob, last word to you.
Well, I'll just echo what Jim and Dan both said. First of all, I don't think that carbon pricing is the only thing. Obviously, there are many, many externalities, as Jim knows. I think in aviation, the health externalities are as big as the CO2 externalities. And by the way, the cost of aviation should be double what it is, and we shouldn't be flying as much. That's just the reality. And the other thing I would say is that I think there has been a fundamental change in the politics. Now, maybe I'm just a dreamer, but it seems to me, and when I headed the CFTC subcommittee, there was no organized, opposition to any of this. Everyone who's in a position today of, other than the Republicans who are scared to tell what they actually understand, everyone understands that we're going to move quickly to net zero, and they're making their plans to do it. And I don't think that fossil fuel money, that dark money, is still there the way it was. You've got shareholders now for all of these major corporations. You've got asset owners organizing. You've got young people who want to be, part of the solution. So I think most people just haven't woken up to the fact that we're all on the same page here, and that we're going to move forward. And it's the politicians who are the last ones to figure that out. But we're very close. And if the Europeans go forward with a border carbon adjustment mechanism, and the US comes through with the carbon tax, which I think it will in the next couple of weeks, and then we also put on a border carbon adjustment mechanism, China is going to come to the table. They're already decarbonizing at a much faster rate than we are. And so we're going to have the US, China, and Europe, I think within maybe the next year or two, leading the effort, and then the rest of the world is going to come on board. And so I think there's going to be a rapid acceleration in the rate of decarbonization, and hopefully, technology and incentives, most importantly, incentives, will lead us to where we need to be.
All right, well, I think that's a great note on which to finish. Debbie, I think you're hearing that you need to be scheduling your conference again in 2 years to attack this topic again and see what we've learned in the interim. Dan and Jim and Bob, thank you so much for a fantastic panel this morning. I know I have learned an enormous amount from your three presentations. I speak on behalf of everybody who's been watching and thanking you for doing this. Dan, especially to you for coming and playing with the finance and economist folks this morning. But this is terrific.
I love economists. I'm a diehard economist fan, so that's great.
Sounds great. All right. Thank you all very much. Debbie, back over to you.
Great. Thanks, Jim and everyone. We have time for a very short break. We'll start the next session at 10:10 at the appointed time.